What's going on, investors? So welcome back to Frunkla. Let's talk about what is about to happen today. We have the FOMC press conference. It's going to be started. I think it's starting in the next 4 minutes or so. Then we're going to have the Fed meeting. Okay, after the interest rate hike decision, Jerome Powell, the Fed chairman, is going to be talking about what he's expecting the next FOMC meeting, how many basis points they are going to be hiking the next interest rate next month, if they are going to stay at 50 basis points or if they are going to be increasing it to 75 basis points. So I want to stay with you guys today. I want to more or less talk about what's going to happen with the market, and I want to stay with you guys while the interest rate hike decision comes in, so that we can take a look at the share price of Bionano Genomics together and see how that is going to affect BNGO, and also provide some information for those of you guys that perhaps want to add to your position today. Okay, we are going to be focusing today on the price action of Bionano Genomics. Once the decision comes in, we have about 3 minutes to go, and then let's see if we can take advantage of this situation. Okay, because I have some of you guys, some of you guys sent me private messages, and asked me to come online today and try to live stream this event, and try to provide some kind of information or guidance about how to perhaps trade today's FOMC meeting. Right now, the share price of BNGO is trading around 1.42 US dollars. So we have about 2 minutes to go. Okay, I have been sharing some very important information with the channel members since 2 days ago. Okay, since we came down to this level, I made several posts to guide them on how to handle this situation. Of course, I have been talking about this FOMC meeting since about 2 weeks now, and most of you guys already are prepared. Okay, I try to prepare the channel members as much as possible, and I think everything is going on as as I shared, and as we planned it to go. So all right, so we have about 1 minute to go. We have 1 minute to go. The Nasdaq is up about 1.7% right now. BNGO is more or less still where it opened, more or less flat. I mean, nothing massive is happening with Bionano Genomics so far. And so we have 1 minute to go. A lot of investors are just expecting them to more or less, instead of 50 basis points, most investors right now expect them to hike it by 75 basis points, and we want to see if that is what the Fed is going to do or not. So that's the plan. Okay, so it's we're going to move this to about 15 minutes so that we can see some action and see if there is anything. So I want to see if the decision is in already. Market levels going into FOMC rate decision. Federal Reserve hikes rate by basis point 75 versus 70. Okay, so it's 75, guys. 75. 75. So it is as investors expected. So I mean, that is good news. Okay, that is what investors expected, and 75 basis points. Let's see how market is going to react to this. The likes of Tesla is up, right now. Nasdaq is up. Several stocks right now are trading, positively. So all right, so this is good. I mean, I have been sharing some posts, to inform you guys about what's going to happen, and that is of course what right now is going on. Okay, and any moment from now we should have more information from the Federal Reserve, and then we're going to have this I'm going to share more information with you guys. Just a second. So Federal Reserve hikes rates by basis point 75 versus 75. Okay, 75 versus 75. The FOMC statement from the 14th to 15th of June 2022 meeting is out along with the updated economic forecast. The market was pricing in an 87% chance of 75 basis point hike, with the remainder on 50 basis points. On the Fed funds futures curve, the terminal top was in May 2023 at blah 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 blah. So this is what's gonna happen, guys. With a part of there is a possibility that next month is also going to be 75 basis points, followed by 50, and then followed by 50. Okay, because before it was 50 and 50, but because of the CPI data that came in last week, and we saw last week it was 8.6% instead of 8.3%. Okay, it was higher than what came in about 2 months ago, and that has forced the Fed to increase the basis points to 75 instead of 50. And that's, I mean, this is good for the market. Okay, it means the Fed is finally turning up and they are trying to do something about inflation. Okay, instead of them just more or less sitting and while inflation gets out of hand. So this is good, but it's too early, because in the next 27 minutes we have the chairman is going to come on board, and it's going to be, you guys can see right here, the Federal Reserve Chairman Jerome Powell will host a press conference at the bottom of the hour at 2:30 p.m. Eastern time. So that is of course when the market is going to really go, if the market is gonna go crazy or not. Okay, because investors want to listen to what he has to say. So we still have about 27 minutes till that speech. We're going to be all these journalists are going to be asking him different kind of questions. So, okay, why inflation is getting out of hand, why the Fed is very slow to hike interest rates, and what they plan to do, and if they are going to even increase it from 75 basis points to 100 basis points, should in case the next CPI data comes in next month. And let's say, for example, right now we have 8.6%, and next month, if analysts expect, let's say 8.5%, and then the CPI data next month comes in at let's say 8.8%, for example. So those are the questions that they are going to be asking Powell in the next 25 minutes or so. What he is going to do if the CPI data comes in higher than expected next month once again. Is it going to increase the basis points to 100, or is it going to maintain 75? Those are all these tricky questions that they are going to be asking him, so that at least investors can know how to prepare for next month. And that is of course going to it's going to affect the stock market either positively or negatively. It depends on what the guy is going to say. Okay, so we have about 26 minutes till this speech. I'm going to try to stay here with you guys, and in the meantime, if you have any question about Bionano Genomics, please use the comment section. Use the comment section and let me know. If you guys have any question about BNGO, we can handle it. I can try to answer it in the next okay, I can try to handle it before the all right. So BNGO right now is more or less down, not really down like that. Okay, it's more or less stable. I think investors are just waiting for the conference meeting, so that they can at least prepare themselves for what is coming next, if the stock market is going to continue to go lower, or if the bottom is in. For those of you that are channel members, I already shared all those information with you guys, how to prepare yourself, and I think you guys are ready. Okay, you're ready for whatever comes. If the stock market goes lower, you know where to get in if you want to get back in, or if you want to close some position and so on and so forth. You know how to handle it. And then if we go higher, you already know all those points. So this more or less what is happening with BNG. You guys can see some more or less some kind of consolidation since 3 days ago. We are more or less consolidating in this price range. All right, guys, so let's talk about the FOMC statement from the June 2022 meeting, Fed hikes by 75 basis points. So we have the statement right here. I mean, I don't want to go through all this. No, blah 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 blah. So I'm not gonna go through all this. I don't think we need to talk about this. Of course, they are going to talk about Russia, Ukraine, how that is affecting the price of oil, and they're going to talk about C-19 lockdown in China, how that more or less disrupt the supply chain. Okay, and then um and also there's a news going on out there that somebody might step down from the Fed member. Okay, they want to kind of pick a scapegoat, and there is a possibility that, where is that, I read that news somewhere here. There is a possibility that Yellen, okay, Yellen, there is a possibility that Yellen is going to be stepping down, guys. Okay, there is a news out there about how Yellen is possibly going to be a scapegoat. She had a meeting, and they said she more or less snitched. Okay, she went off. Where is it? All right, so look at this. Sorry. So Yellen has never been a great communicator. She revels in simplicity and models around messaging, but reports said she went off message in a May 31st interview where she admitted she was wrong. So, more or less some kind of politics going on. There's a possibility they're going to do, they will choose Yellen, and the Fed is going to blame her for whatever is going on with with inflation right now, and why they are slow to adjust. So this is the FOMC dot plot and central tendency. Okay, this one is also very important. It's going to tell us what the Fed is going to be doing next. So as you guys can see right here, the dot plot for 2022 right now is around more or less around 2 points, around 3.5, 2.8 or something like that. Okay, that's 3.4, 3.5% for 2022. And then for 2023, they are more or less above 3.5 right now. Okay, for 2023. And then for 2024, they are back, around 3.4%. And then 2025 or longer term, the Fed is targeting 2.5. It's no more, they used to say that they are targeting 2%, but right now I think they are targeting 2.5% in the long run, because nobody knows when this Russia-Ukraine war is going to be over, or when the oil price is going to come lower, and so on and so forth. So for 2022, their target is more or less now 3.4%. Okay, 3.4%. This one is very important. It's going to help you guys to know what you should expect, okay, with the likes of Bionano Genomics. Okay, that is why this is very important. So according to this post, the dot plot for June 2022 shows the median rate at the end of 2022 at 3.4%. Okay, right here, up from 1.9% in March 2022. So you guys can see, I mean, for 2022 they were targeting 1.9%. So you guys can see how far the Fed have been behind this hiking. Okay, so they were targeting 1.9%, but right now they have moved it to 3.4%, which is very good, okay, for the markets. I mean, before inflation gets out of hand, they have to do something about it. So with the current rate at 1.63%, that's where we are today. 1.63%. It means we are more or less, we still have about 100% to go. So that implies an additional, look at that, 177 basis points to go. Okay, 177 basis points. That is 1.77. For 2023, the median Fed funds target rate is up to 3.8% from 2.8%. Just like I said, they were targeting 2.8% for next year, but right now it is up to 3.8%, guys. And this is very dangerous. Okay, I mean, if they get, if they go crazy about hiking interest rates, and the economy is not as strong as they think it is right now. Okay, if the economy is not as strong as they think it is, if all these companies out there, such as Tesla, for example, start to lay off, or they reduce, just like Bionano Genomics, for example, okay, they say they are going to reduce the amount at which they are hiring new talent. They are going to reduce it. They are going to take it easy with hiring, which, I mean, some companies out there are already filing for bankruptcy, and some are already laying off workers. And if that continues, okay, it means the economy is not as strong as the Fed is thinking. Fed is still saying that, okay, you know citizens have enough money, stored in the saved in the bank. They have enough money to spend, blah blah blah. But if that's not the case, if everyone stops, spending money on everything, and inflation start to get really, affect the cost of food, the cost of energy, and everybody just, more or less, reduce the rate at which they spend money, and then we see that recession, and there is a possibility all this mess is even going to lead to deflation. That is one thing that I don't think these people are more or less worried about right now, because they are going crazy with inflation. Hopefully the economy is going to stay strong, and we are not going to be seeing some kind of layoff, which is of course going to affect okay the economy, which is of course going to lead to more or less massive recession. And nobody knows if we go into, right now we are not in recession, okay? If we go into recession, nobody knows when that is going to be over. So we have about 18 minutes before um the conference meeting, so stay with me, guys. We have about 18 minutes, and so you guys can easily, hey, you guys, I'm doing good. I have a little bit running nose, but I'm going to survive it. So what's going on with BNGO price action right now? Nothing big is going on. I mean, we are more or less where the market, at 1.4%, 4 points US dollar. Nothing is really, we're not going up, we're not going down. So still the same thing. Let me switch over to the 1 hour candlestick, and so that we can see what is really happening. So this more or less what is happening right now, okay? This is more or less what is happening right now. This is 1 hour candlestick. My computer is extremely slow, guys. My computer is so now let me quickly talk about, because we have some filings from Bionano Genomics insiders. We have some filings from insiders, and let's quickly talk about that so that we have about 15 minutes before the conference meeting. So we have some insider filings from Bionano Genomics, and some of you guys, asked me if this is what this means for BNGO, okay, for the price of BNGO. Let's go to SEC filings and see all these latest filings. So all this filing, oh my god, look at that, guys. All this came in 1 2 3 4 5 6 7 8. We have 8 filings, okay? Form 4, 8 Form 4 file. 1 2 3 4 5 6 7, yeah, 8 Form 4 filings on the 13th of June, and I am yet to speak about this, okay? So let's take a look at it one after the other and see how many shares has been granted to most of all this. I think these are just the members of board members. This is a director, for example. This person is Vori Christina MD. This is a female. So she was amount 164,422 shares of BNGO. The code is A, and at 1.62 US dollars. I think this was during that before the CPI data came in. So this is stock option, okay? Stock option, the right to buy at 1.62 US dollars. This is good. I mean, insider, holding is increasing. That is good. And last month we saw some filing from the CEO of Bionano Genomics, from the chief operating officer as well. I think they sold few shares. They sold about, I think the CEO sold about 50,000 shares of BNGO, and some argue that it's more or less perhaps he wants to pay some tax or something like that. And some people are even saying that this guy got about 5 million US dollars in compensation last year, and why would he be selling some shares of BNGO, blah blah blah. So this is the first one. Let's take a look at the second one, okay? Let's take a look at the second one. So this is the second one. I know this person. This is Tuome Christopher J. So this person was also granted 164,000 shares, more or less, of BNGO at 1.62 US dollars. The right to buy, the code is A. And so okay. So this one is also good. That's the second one. I think most of them, perhaps all of it is more or less from the board members, okay? This is also from another director, Wong Vincent Jong Fai. The same amount, 164,422 shares of BNGO. The fourth one, so the fourth one is also a director. This Baker David L, the same amount, 164,422 shares of BNGO. So I'm just gonna go to the last one. Okay, let's take a look at the last one. So this one is okay, so this is just document details, blah blah blah. Let's go back. This one. So this one, the second to the last. This one is from Mamushka Hannah. She's also a director. The same amount, 164,000. Now, if we want to, what we can do is we can go and check out, how this has affected Bionano Genomics. Okay, if this has affected BNGO positively, I'm going to so BNGO right now is trading at 1.41 US dollars. Okay, nothing really big is going on right now. Okay, nothing big is going on. The market is more or less still the same. I think investors are still waiting for the conference meeting. They want to hear from the, so we have it right here. Okay, we have the conference meeting right here. We have about 13 minutes to go. Okay, so I want to show you guys fintech. Okay, let's go to Fintel. Let's go to Fintel and see how this has helped Bionano Genomics. Okay, and there is also something I want to talk about in this Fintel. There is also something I would love to talk about. Okay, I want to first of all bring you guys attention to these institutional shares. Okay, you guys can see that right now this is 26.08%. Okay, 26 point, this used to be about 30% last month, so it has more or less dropped to 26%. So you guys want to, I am also paying attention to this. I spoke briefly about this with the channel members that this is not really a positive sign. Okay, I mean, we're supposed to be having institutional investors should be increasing, the number should be increasing, not decreasing. I think right now retail investors, I wish there is a way to see how many shares of BNG retail investors are presently holding, and only Bionano Genomics have access to such information, in my opinion. So we don't have access to that information, and there is a possibility that retail investor holding has increased. The percentage of retail investors holding BNGO shares, I believe it has increased. Meanwhile, institutional investors has decreased. Okay, numbers of institutional investors presently holding Bionano Genomics. But the thing is, this doesn't really mean, it's not really completely negative for BNG, because we have most of the large guys, because some of these institutional investors are just holding few shares of the company. Okay, not even up to, some are not even holding up to 20,000 shares. So as you guys can see right here, for example, look at that, Humankind Benefit Corporation, whatever, 1,000 shares. You guys can see this is an example of and this person, for example, if this fund, for example, sells BNGO, then the number is going to go lower. So but as you can see, we have the likes of Vanguard. They increased their position by 2.5%, for example. And look at this, for example, Vanguard Total Stock Market Index Fund investor shares also increased 11.9% right now, 8.8, okay, 8.8 million shares. And I want to go down, but this page is hanging. My computer is getting super slow, guys. Just a second. Just a second. This page is very heavy. Okay, so let's go down. So look at that, we have the likes of this is TX Stock Index Fund, holding just about 4,860 shares of Bionano Genomics, so and so on. Look at this one, 13,000. So all these small holders, for example, if they sell their position right now, the percentage of institutional ownership of BNGO is of course going to go lower. But meanwhile, we have some increasing their position as well. This one is increasing, and yeah, and that is it. And of course, some of them are also decreasing their position, and some of them are more or less short. This is an example of short. For example, Blackstone Alternative Investment Fund, they are short in BNGO. Okay, minus 43,100 shares of BNGO. Okay, so yeah, so that is that about that. Now let's take a look at insiders. Okay, insider trades. We still have about 10 minutes before the conference meeting of the Fed chairman. We have about 10 minutes to go. So total insiders 35. Insider ownership is now 6.1%. Okay, 6.1%. And I think I still need to cross check it. I think this was more or less around This was less than 1% when I started to talk about Bionano Genomics. This was less than 1%. And the last time I checked, I think it was around 2 or 3%. The last time I checked, this more or less double, guys. This almost double. Shares outstanding 289.6 million shares. Insider shares 17.6 million shares. Okay, like I already shared with you guys, we have some insiders, some board members, they filed on the 13th of this month, and they have been given the right, to buy shares of BNGO, about 164,000 shares each. About seven members, 164,000 shares. So that's millions of shares, and this is, in my opinion, okay, good for BNGO. While institutional ownership is decreasing, insider ownership is increasing, and I believe retail investor ownership is also increasing, because I have some friends that are presently more or less buying BNGO on a daily basis. Okay, these guys right now are sitting on over 25,000 shares of Bionano Genomics. So yeah, this is good. Okay, what's up? Okay, so this is good, in my opinion. It is increasing. I mean, they need to show some kind of, they need to increase investors confidence. Okay, I mean, they have to show us that they are also, they believe in the company, and of course they have to take advantage of this very cheap price of Bionano Genomics. Okay, because right now the share price of BNG is more or less, trading close to nothing compared to where it was last year February. Okay, so this is good. Generally, in my opinion, this is good. Okay, so this is good. Now these are the latest filing, as you guys can see right here. Insiders percentage. I need to log into this page before I can see all this information, but right now it's too late for me to log in. Okay, so please just bear with me. So shares owned, look at that, 5 million shares, 121,000, and so on and so forth. 2.9 million shares, 1.9 million shares, and it goes on 2.9 million shares. And all right guys, so this is good. Look at that, shares owned. I think this one is the latest filings. Shares owned 5,013, 216, blah blah blah. And then we have, all these shares right here. These are some of the members, board members. You can see how many shares some of them are sitting on. 2.2 million shares, 2.9 million shares. Okay, they are sitting on a lot of. And I think Eric right here, Eric is of the CEO of Bionano Genomics, is showing 538,556. And I think this guy is sitting on millions of shares. Okay, I don't think this is correct. I already spoke about that. I think this guy owns, more shares than that. So all right, so this is the this one is from last month. All right guys, so that is that about that. Okay, that is that about insiders. And we have about 6 minutes left before the conference meeting. The price of BNG right now is more or less the same. Nothing is going on, as you guys can see. I think investors are just waiting to hear from the Jerome Powell to make decision about what to do with their investment, how to go forward. Okay, if they have to take profit, if they have to short the market, increase their puts, or if they have to increase their call options. Okay, so this more or less a consolidation, guys. This is a consolidation. This right here is a consolidation. Okay, I'm going to put, let's put a more or less a trend line, so that we can, at least the next time we come back here, we can know if there is a breakout or not. Okay, I'm going to put a trend line here. So I'm going to put a trend line. Should, in case the meeting starts and then you see the price dropping below 1.38 US dollars, there seems to be some kind of trend line. Okay, I mean, don't take this super serious, but this is just to help us during this live stream. Okay, it's just to help us. So should, in case the price moves lower, then we can expect it to go back down to this level, around this 1.33 US dollars level. So there's more or less a uptrend. Okay, this is a short-term uptrend. And if Jerome Powell speaks something positive, this should be good for the market. So let's just wait and see what's gonna happen. We have about 4 minutes left. Since nobody is asking me any question, we just have to wait and see what's gonna happen. In the meantime, what can I share with you guys? Okay, in the meantime, what can we talk about? Bionano Genomics. There is no news about BNGO out there. I mean, last week they went crazy. They attended several, meetings. They attended several. They went to ESHG. They went to. I think the chief business officer is still in Europe with the chief informatics officer, Dr. Shams. I think both of them are still in Europe right now. I think they are going to Spain. There is another conference, another genomic conference in Spain. I think that's where they are going right now. They are presently, in Europe, in my opinion, right now. Not really completely sure, but I think they are still in Europe, and they are going to be attending that, so the volume right now is 4 million shares. The average volume is 6.7. This has been dropping, guys. This used to be about 8 million shares. It has dropped to 6.7. Today is possibly the last day that investors are waiting for, in my opinion. Okay, I mean, after this meeting, then we can know what we should expect for the next 2 months again. Hopefully next month inflation is not going to, the CPI data is not going to be higher than 8.6%. But if it comes out higher than expected, then we are in for a ride, guys. Bionano Genomics, if you take a look at the earnings, BNGO has more or less missed four earnings estimates. Okay, during the this one is from the second quarter of 2021, they missed it. The third quarter of 2021, they missed it. The fourth quarter of 2021 also they missed, and then last quarter Q1 2022 they also missed it. Okay, the estimate was -7 cents, but they reported -11. And so for the second quarter of 2022, analysts have already set an estimate of -9, and then hopefully we'll see what's gonna happen, guys. I mean, hopefully they have managed to install enough Sapphire devices, and we also have that supply chain bottleneck affecting BNGO. We have the supplier, the Sapphire device supplier. No, the consumable supplier, was having problem, and they couldn't supply enough consumables. And according to Bionano Genomics, that is one of the the reasons why they missed estimate in the fourth quarter of last year and the first quarter of this year. Okay, that's because of consumables. Okay, and hopefully that has been sorted, and because in the first quarter, I think they more or less they sold about 3,000 I think they sold about 3,000 flow cells in the first quarter of this year, 3,000 something, maybe 3,100 or 3,020 or something like that. I'm not really sure. So hopefully they are going to be selling more than that in the second quarter. I mean, my estimate was them to sell at least 3,500 and higher, okay, back in the fourth quarter of 2021, but they missed that estimate because of the problem they had with the supplier, and hopefully that has been sorted. And then I mean, in Q2 we will see what's going to happen in Q2. Okay, during the earnings of Q2 we will see. So that's also one of the things that I am presently monitoring, and then we are going to also more or less see how many how much they've spent, okay, in terms of expenses. Okay, so we are live, guys. Almost. Let's see what Powell is going to say, and then I can try to tell you guys what we should be expecting going forward. Interest rate. BNGO is flat, $1.4, 1.4, $1.41 flat. Nasdaq is up about 1% right now. Okay, the Nasdaq is up about 1%. Dow Jones is more or less flat. S&P 500 is a little bit up. All right, guys.
Good afternoon. I will begin with one overarching message. We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a half percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Howard Schneider with Reuters. Two related questions. Chair Powell, did you feel you boxed yourself in with the language you used at the last press conference on 50 basis point hikes in June and July? And would you please give us as detailed a sense as you can of what role you played in reshaping market expectations so quickly on Monday?
So, as you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve, when they understand our objective function, our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if the economy performed, if data came in worse than expected, then we would consider moving even more aggressively. So we got the CPI data and also some data on inflation expectations late last week, and we thought for a while, and we thought, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead, and so we did. And that's really how we made the decision.
Okay, Gina?
Thanks for taking our questions. Gina Smilik with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have, and why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels, and we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, in that range in that more normal range, and that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward. Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at a modestly restrictive level at the end of this year, and that's 6 months from now. And so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are, and that's what they want to see, knowing what they know now and understanding that we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much. And if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening in a range of maybe 3.5 to 4%. And that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seem like the right thing to do at this meeting, and that's what we did.
Steve.
Steve Leisman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year, do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, Could you break that apart for me? How much of that is restrictive, and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look at, asset prices. You can look at the effect you're having on the economy, rates, asset prices, credit spreads. All of those things go into that. You can also look at the yield curve and ask all along the yield curve, where is the policy rate? So for much of the yield curve now, real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of financial conditions. So I think I have to look at it this way. We move the policy rate, that affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see, demand moderating. Demand is very hot still in the economy. We'd like to see the labor market getting better in balance between supply and demand. And that can happen both from supply and demand. Right now, demand is substantially higher than available supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be, the things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still pushing upward on inflation. So that's really how I think I would think about it.
But does 3.8%, 4% get it done? Does it get the job done of breaking the back of inflation?
I think it's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean, honestly, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days, so I would think it would. But you know what? We're going to find that out empirically. We're not going to be completely model driven about this. We're going to be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Thank you, Nick.
Thanks. Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering, on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So if you look at we look at a broad range of inflation expectations. So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see. If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised nonetheless. It was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up after being pretty flat for a long time. So we're watching that, and we're thinking, this is something we need to take seriously. And that is one of the factors, as I mentioned, one of the factors in our deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI reading.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
You know, I'll just say we're going to react to the incoming data and appropriately, I think. So I wouldn't want to put a number on what that might be. The main thing is to get rates up, and then pretty soon we'll be in an area where we're, I think, as you get closer to the end of the year, you're in a range where you've got restrictive policy, which is appropriate. 40-year highs in inflation. We think that policy is going to need to be restrictive, and we don't know how restrictive. So I think that's how we'll take it.
Thanks, Neil.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions. The late-breaking kind of decision to go to 75 basis points, do you worry that that will make policy guidance a less effective tool in the future? And should we think of that as a kind of symmetrical reaction function if we start to get soft readings on inflation, or if the labor market starts to roll over?
To take your second question first, yes. I mean, I think we're resolved to take this on, but we're going to be flexible in the implementation of it. Sorry, and your question was guidance. So again, the overall exercise is that we try to provide as much clarity about our policy intentions as we can, because we think that makes monetary policy work better. It's always a trade-off, because you have to live with that guidance. And so you do it, and it helps a lot of the time. I frankly think this year has been a demonstration of how well it can work. With us having really just done a very little in the way of raising interest rates, financial conditions have tightened quite significantly through the expectations channel, as we've made it clear what our plans are. So I think that's been a very healthy thing to be happening. So, and I would hope that it's always going to be any guidance that we give is always going to be subject to things working out about as we expect. And in this particular situation, we're looking for something specific, and that is progress on inflation. We want to see progress. We want to see inflation can't go down until it flattens out, and that's what we're looking to see. And if we don't see that, then that's the kind of thing that will cause, even if we don't see progress for a longer period, that could cause us to react. But we will soon enough. We will be seeing some progress at some point. And we'll react appropriately to that too. But I would like to think, though, that our guidance is still credible, but it's always going to be conditional on what happens. This is an unusual situation to get, some data late during blackout, very close to our meeting. Very unusual to one that would actually change the outcome. So. I've only seen, in my 10 years plus here at the Fed, I've only seen something like that, even close to that, 1 or 2 times. So I don't think it's something that'll come up a great deal.
Colby.
Thank you so much for taking our questions. Colby Smith with the Financial Times. On the clear and convincing threshold for the inflation trajectory, what is the level of realized inflation that meets that criteria? And how is the committee thinking about the potential trade-off of much higher unemployment than even what's forecasted in the SEP if inflation is not moderating, at this acceptable pace?
Sorry, the second part I didn't get.
What's the potential trade-off with higher unemployment than even what's forecasted in the SEP if inflation is not moderating at an acceptable pace?
Right. So what we want to see is a series of declining monthly readings for inflation, and we'd like to see inflation headed down. So, and right now our policy rate is well below neutral, right? So, soon enough we'll have our policy rate. Let's assume the world works about like the SEP says. The policy rate will be up where we think it should be, and then the question would be, do you slow down? Does it make you, you'll be making these judgments about, is it appropriate now to slow down from 50 to 25, let's say, or speed up? So that's the kind of thinking we'll be doing, and we're looking, ultimately, we're not going to declare victory until we see a series of these, really see convincing evidence, compelling evidence that inflation is coming down. And that's what I mean by, that's what it would take for us to say, okay, we think this job is done. Because we saw, and frankly, we saw last year, inflation came down over the course of the summer and then turned right around and went back up. So I think we're going to be careful about declaring victory. But again, the implementation of our policy is going to be flexible and sensitive to incoming data.
Are you more concerned now that to bring down inflation, it's going to require more than just some pain at this point?
So again, I think that I do think that their objective, and this is what's reflected in the SEP, but our objective really is to bring inflation down to 2% while the labor market remains strong. I think that what's becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And there I'm thinking, of course, of commodity prices, the war in Ukraine, supply chain, things like that, where we really can't, the monetary policy stance doesn't affect those things. So, but having said that, there is a path. There's a path for us to get there. It's not getting easier. It's getting more challenging because of these external forces, and that path is to move demand down, and you have a lot of surplus demand in take, for example, in the labor market. So you have two job vacancies essentially for every person actively seeking a job, and that has led to a real imbalance in wage negotiating. You could get to a place where that ratio was at a more normal level, and you would expect to see those wage pressures move back down to a level where people are still getting healthy wage increases, real wage increases, but at a level that's consistent with 2% inflation. So that's a possibility, and you could say the same thing about some of the product markets where there's just excess capacity, and where the strong demand has gone into where they're capacity constrained, right? So you have effectively what we think of as a vertical supply curve or close to it. So demand comes in and it's very strong, and it shows up in higher prices, not higher quantities, not more cars, because they can't make the cars because they don't have the semiconductors. So in principle, that could work in reverse. When demand comes down, you could see, and it's not guaranteed, but you could see prices coming down more than the typical economic relationships that you see in the textbooks would suggest, because of the unusual situation we're in on the supply side. So there's a pathway there. It is not going to be easy, and again, it's our objective, but as I mentioned, it's going to depend to some extent on factors we don't control.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. So the new projections show the unemployment rate ticking up through 2024. Is a higher unemployment rate necessary in order to combat inflation? And what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation? Thank you.
So you're right. In the SEP, we have unemployment going up to 4. The median is 4.1%. There are, of course, a range of actual forecasts, and I would characterize that if you were to get inflation down to, on its way down to 2%, and the unemployment rate went up to 4.1%, that's still a historically low level. We hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year in the last 50. So the idea that 3.6% is historically low in the last century. So a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be I think that would be a successful outcome. So we're not looking to have a higher unemployment rate, but I would say that I would certainly look at that as a successful outcome.
Does that include people losing their jobs, or?
We don't seek to put people out of work. Of course, we never think too many people are working and fewer people need to have jobs. But we also think that you really cannot have the kind of labor market we want without price stability. And we have to go back and establish price stability so we can have that kind of labor market. And that's a labor market where, where workers are getting wage increases. Maybe the workers at the lower end of the spectrum are getting the biggest wage increases, as they were before the pandemic, where participation is high, where there's lots of job opportunities, where it's just the labor market we had before the pandemic that's what we want to get back to. And you see, disparities between various groups at historic lows. We'd love to get back to that place. But to get there, it's not going to happen with the levels of inflation we have. So we have to restore that, and it really is in service in the medium and longer term of the kind of labor market we want and hope to achieve.
Hi, Chair Powell. Matthew Bosa with Bloomberg. So as you just mentioned, the committee is now projecting a 0.5 percentage point rise in the unemployment rate and the SEPs over the next couple years. And it removed a line from its policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that that is still your objective, though. So I'm wondering if you could explain why that line was removed from the statement, and also whether this means the FOMC is trying to induce a recession now to bring inflation down.
Not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence. Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. That the SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. The sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate, so we took the sentence out.
And given the new projections for the unemployment rate, could you talk a little bit about what accounts for such reduced confidence against, say, a month ago or 3 months ago, that inflation will largely normalize on its own as these supply side issues get worked out? Thanks.
Well, yeah, I think you've seen, again, we've been expecting progress, and we didn't get that. We got sort of the opposite. So I also think the situation, really since the consequences of the Ukraine war become more and more clear, what you're seeing is the situation getting more difficult. And you look around the world, I mean, lots of countries are looking at inflation of 10%. And it's largely due to commodities prices. But all over the world, you're seeing these effects. And so, and we're seeing them here. Gas prices, all-time highs and things like that. That's not something we can do something about. So that is really, and by the way, headline inflation is important for expectations. The public's expectations, why would they be distinguishing between core inflation and headline inflation? Core inflation is something we think about because it is a better predictor of future inflation. But headline inflation is what people experience. They don't know what core is. Why would they? They have no reason to. So expectations are very much at risk due to high headline inflation. So it's become, the environment has become more difficult, clearly, in the last 4 or 5 months. And hence the need for the policy actions that we took today, hence our resolution to get rates up and ultimately get them to where we think they need to be in coming months.
Thanks, Chair Powell. Edward Lawrence with Fox Business. I want to ask you, you talked about CPI going to 8.6%. The retail sales surprised the market by falling, and then revisions to the previous months were down. Are you hearing from contacts about consumers slowing spending or changing their habits?
So we're, of course, watching very, very carefully for that, and looking at the retail sale, the big store numbers and all that kind of thing. And so, but I think the fair summary of what we see is you see continuing shifts in consumption. You see some things sales going down, but overall, spending is very strong. The consumer's in really good shape financially. They're spending. There's no sign of a broader slowdown that I can see in the economy. People are talking about it a lot. Consumer confidence is very low. That's probably related to gas prices, and also just stock prices to some extent for other people. But that's what we're seeing. We're not seeing a broad slowdown. We see job growth slowing, but it's still at quite robust levels. We see the economy slowing a bit, but still growth levels, healthy growth levels.
So then as you are raising rates in this economy, how closely are you watching consumer spending, or is there another indicator that you're watching more closely?
It would be hard to watch anything much more closely than we watch consumer spending. But we watch everything. We watch business fixed investment, which actually has softened a bit. We're responsible for watching everything. But, consumption is 60-some% of the economy, 2/3 of the economy. So naturally, we spend a lot of time on that. And again, there's a lot going on. There are a lot of flows back and forth. But ultimately, it does appear that the U.S. economy is in a strong position and well positioned to deal with higher interest rates.
Michael McKee.
Thank you, Mr. Chairman. Michael McKee from Bloomberg Radio and Television. Are you targeting headline inflation now or core inflation? In other words, how far would you chase oil prices if they keep going up, if that's going to be the component that drives expectations? Would you risk recession for a headline rate if the core rate is holding steady or starting to go down?
So we're responsible for inflation in the law, and inflation means headline inflation. So that's our ultimate goal. We, of course, like all central banks do, look very, very carefully at core inflation because it's a much better predictor, and it's a much better predictor of where inflation is going, and it's also more relevant to our tools. As I mentioned, the parts that don't go into core are mostly outside the scope of our tools, so we look at that. But the current situation is particularly difficult because of what I mentioned about expectations. We can't affect. Really, the energy prices are set by global commodity prices, and most of food, not all of it, but most food prices are pretty heavily influenced by global commodity prices too. Also other things. So we can't really have much of an effect, but we have to be mindful of the potential effect on inflation expectations from headlines. So it's a very difficult situation to be in, and we can't do much about the difference between the elements that make up headline that are not in core.
Could I just, as a follow-up, get a clarification on the SEP? When the members gave their forecasts, when were they inserted into the record? Were they revised after the CPI or Michigan numbers came out? In other words, does the SEP as we have it now reflect the same factors that led you to go to a 75 basis point move?
The SEP is of one piece. It reflects all of the economic readings. It also reflects the 75 basis point increase. This is important. So people had that in hand when their SEPs were submitted. So in other words, it's not in addition to what's in the SEP. The SEP, everyone's SEP reflects their thinking about this rate increase and what's going forward.
Victoria.
Hi, Victoria Guida from Politico. I wanted to ask about how you're measuring progress, especially since you've now started front-loading rate hikes more. You've talked about how you want to see inflation coming down over a series of reports, and I guess I'm curious whether you think inflation data itself is a really good indicator, or whether you might be concerned that it's a lagging indicator or that it might send confusing signals given that, as you've talked about, there are sort of supply and demand aspects. And I guess my question is, do you think that inflation data will tell you when you've gone to where you need to go, or do you just feel like maybe it's better to overshoot than to undershoot?
So I think the role that we can play, maybe the way to get at it is to say that the role that we can play is around demand, right? So, and we'll be able to see the areas that we can affect are those that are associated with excess demand. And we'll be able to see our effect on, for example, job openings in real time. So, and that would tell us about wages. Wages are not principally responsible for the inflation that we're seeing, but going forward, they would be very important, particularly in the service sector. So, sorry, I'm not sure I'm getting to your question.
My question is inflation data itself the best indicator for when you're getting to where you need to go, or might it lead you to go too far?
There's always a risk of going too far or going not far enough. And it's going to be a very difficult judgment to make, or maybe not. Maybe it'll be really clear. But we're quite mindful of the dangers. But I will say the worst mistake we could make would be to fail, which it's not an option. We have to restore price stability. We really do. Because everything, it's the bedrock of the economy. If you don't have price stability, the economy is really not going to work the way it's supposed to. It won't work for people. Their wages will be being eaten up. So we want to get the job done. This inflation happened relatively recently. We don't think that it's affecting expectations in any kind of fundamental way. We don't think that we're seeing a wage price spiral. We think that the public generally sees us as very likely to be successful in getting inflation down to 2%, and that's critical. It's absolutely key to the whole thing that we sustain that confidence. So that's how we're thinking about it.
Hi, Brian Chung with Yahoo Finance. I just want to expand, I guess, on what you just said now about the general public feeling like you can get this done. When you talk about consumer sentiment being down, household inflation expectations being up, recession just broadly being dinner table talk, does the general feel among American households and also businesses square with your explanation of the economy, given that the description of inflation in the statement didn't change between May and June? Thanks.
So clearly, people don't like inflation a lot, and many people are experiencing it really for the first time, because we haven't had anything like this kind of inflation in 40 years, and it's really something people don't like, and they're experiencing that, and that's showing up in surveys and in all kinds of ways. And we understand that, and we understand the hardship that people are experiencing from high inflation, and we're determined to do what we can to get inflation back down. So that's really what we're saying. Clearly, it's an incredibly unpopular thing, and it's very painful for people. So, I guess what I'm saying is the question, really critical question from the perspective of doing our job, is making sure that the public does have confidence that we have the tools and will use them, and they do work to bring inflation back down over time. It will take some time, we think, to get inflation back down, but we will do that.
Chris.
Thank you. Chris Rugaber at Associated Press. You have talked about inflation a few times and mentioned oil prices, China lockdowns. But aside from rises in commodity prices such as gas prices, we're also seeing stickier measures of inflation increasing, such as the Cleveland Fed's median and trimmed mean CPIs. I mean, how persistent do you see those underlying measures of inflation, and how do you expect to, where do you see those going in the near future?
Yeah. So, as I mentioned, I think in my opening statement, the inflation has started off in quite narrow, very directly pandemic-related areas, and it's spread now broadly across the economy and into the services sector as well. It was really in the goods sector at the beginning. In particular, you're seeing in travel now, if you've flown on a plane lately, planes are very full and plane tickets are very expensive. some of that will be passed through of energy prices, but it's so you're experiencing services inflation. Shelter inflation is high. So so the question, and you see the Cleveland measure going up, and many other measures are going up. So it's a time when we're not seeing progress, and we want to see progress, and that's really another part of why we did what we did today, and why the SEP looks like it does, is that we see it as appropriate to get the policy rate up to restrictive levels, which would be, in the thinking of the committee, somewhere in the range of 3 to 3.5% by year end, and then after that, you see what the rest of the SEP says. So I hope that's responsive to your question.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Do you still think a softish landing is possible, and how would you define that at this point, considering the revised projections for unemployment, GDP, inflation?
So I think what's in the SEP would certainly meet that test. If you see, you're looking at getting back down to almost a 2% inflation by 2024, and the unemployment rate is still as low as 4.1%. That would be, I would call that as meeting that test. Do I still think that we can do that? I do. I think there's. I don't want to be the handicapper here. That is our objective. And I do think it's possible. Like I said, though, I think that events of the last few months have raised the degree of difficulty, created great challenges, and again, the answer to the question, can we still do it? There's a much bigger chance now that it'll depend on factors that we don't control, which is, fluctuations and spikes in commodity prices could wind up taking that option out of our hands. So we just don't know. But we're focused on, very, very focused on getting inflation back down to 2%, which we think is essential for the benefit of the public, and also to put us on a path back to a sustainably strong labor market like the one we had before the pandemic.
Greg.
Thank you. Greg Robb from MarketWatch. Chair Powell, I was wondering if you could talk a little bit more. Economists are worried that you're kind of hitting the economy with a sledgehammer, and that now there's even more risk of a recession than a 50-50 path of rates. So could you talk a little bit more about that, and what evidence would get you to stop rate hikes and maybe even reverse them?
Sure. So, as I mentioned, financial conditions have tightened over the last 7 months, and that's a good thing, we think. But the federal funds rate, even after this increase, is at 1.6%. So it's hard to see how that is too high of a rate. And even if we did another, we're going to get here by the end of the summer somewhere in the 2s probably. Still, that's still a low rate. So that's not a rate that is calculated to bring a recession on. And by then we'll have seen a whole lot more data. As I mentioned a couple times, the committee's views are around a modestly restrictive stance, which would be in the 3 to 3.5% range by the end of this year. But that's conditioned on that being the appropriate thing to do. If we see data going in a different direction, it'll be reflected in our policy, as you see today. We'll be watching if things go in a direction we don't expect, then we're going to adapt. And I would say this is a highly uncertain environment, extraordinarily uncertain environment. So again, we'll be determined and resolved, but flexible.
Okay, Evan.
Evan Reiser, Market News International. Thank you, Chair Powell. I was wondering if the Fed has initiated a review of the conduct of monetary policy over the last 2 years or so, given the inflation, and will that be shared with the public? And then secondly, given the illiquidity and extraordinary volatility in financial markets, are you concerned that QT will make that worse?
Sorry, what was your question on QT?
Just given the illiquidity and extraordinary volatility in financial markets, whether QT will make things worse.
So, of course, we've been looking, very carefully and hard at why inflation picked up so much more than expected last year and why it proved so persistent. it's hard to overstate the extent of interest we have in that question, morning, noon, and night. So, but you have to understand the context. Really, the context is this: for decades before the pandemic and the reopening, you had a world where inflation was dominated by disinflationary forces such as declining population or aging demographics, let's call it that, globalization enabled by technology, other factors, low productivity. So, and that's how all the models work. It is decades and decades of data. They look at that. It's a very flat Phillips curve work, and the supply shocks tend to be transient, right? So we have now experienced an extraordinary series of shocks, if you think about it. The pandemic, the response, the reopening, inflation, followed by the war in Ukraine, followed by shutdowns in China, the war in Ukraine potentially having effects for years here. So we're aware that a different set of forces are driving the economy. We have been, obviously, for quite a while, that these forces are different. Inflation's behaving differently. And in our thinking, it really is a question of very strong demand, but you couldn't get this kind of inflation without a change on the supply side, which is there for anybody to see, which is these blockages and shortages and people dropping out of the labor force and things like that. So that's how we're looking at it. And we've done a lot of work internally on and thinking about what all that means. The thing is, you don't know whether those forces are, what extent are they going to be sustained? In other words, will we go back to a world that looks a little more like the old world, or are we really going to be in a world where major supply shocks go on and on? The history is you see these waves of supply shocks, as you did in the 70s, and then they go away, and sort of there's a new normal and things settle down. But honestly, we don't know what that's going to be. In the meantime, we have to find price stability in this new world and maximum employment in this new world where clearly inflationary forces you're seeing them everywhere. Again, if you look around the world at where inflation levels are, it's absolutely extraordinary. It's not just here. In fact, we're sort of in the middle of the pack, although I think we have, of course, a different kind of inflation than other people have, and partly because our economy is stronger and more highly recovered. So that's what we're doing. We've done a lot of introspection and work on that. And on QT, we've communicated really clearly to the markets about what we're going to do there. Markets seem to be okay with it. We're phasing in. Treasury issuance is down quite a lot from where it's been. So I have no reason to think, markets are forward-looking and they see this coming. I have no reason to think it will lead to illiquidity and problems. It seems to be kind of understood and accepted at this point.
Thanks. For the last question, we'll go to Mark Hamrick.
Mr. Chairman, Mark Hamrick with Bankrate. Wonder what your assessment is about the outlook for the housing market, given the years-long increase in home prices and now the sharp rise in mortgage rates. And all that, of course, given the heightened sensitivity around the housing market, given the fact that it was a trigger for the great financial crisis over a decade ago. Thank you.
Sure. So rates were very low. A good place to start is that rates were very, very low for quite a while because of the pandemic and the need to do everything we could to support the economy when unemployment was 14% and the true unemployment rate was well higher than that. So, and that was rates are low, and now they're coming back up to more normal or above levels. So in the meantime, while rates were low and while demand was really high, obviously demand for housing changed from wanting to live in urban areas to some extent to living in single-family homes in the suburbs, famously. And so the demand was just suddenly much higher and low. So we saw prices moving up very, very strongly for the last couple of years. So that changes now, and rates have moved up. We're well aware that mortgage rates have moved up a lot, and you're seeing a changing housing market. We're watching it to see what will happen. How much will it really affect residential investment? Not really sure. How much will it affect housing prices? Not really sure. It's, obviously we're watching that quite carefully. You would think over time, so there's a tremendous amount of supply in the housing market of unfinished homes. And as those come online, whereas the supply of finished homes, the inventory of finished homes that are for sale is incredibly low, historically low. So that it's still a very tight market. So prices may keep going up for a while, even in a world where rates are up. So it's a complicated situation. We watch it very carefully. I would say if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together, and where inflation is down low again, and mortgage rates are low again. So this will be a process whereby we do our work in a way where the housing market settles in a new place, and housing availability and credit availability are at appropriate levels. So thank you very much.
Alright guys, so that was it. I think I'm still going to make a separate video, a very short video, to let you guys know, what my opinion is about this conference meeting and what I have been able to jot. I jot a lot of things. As you guys can see, I wrote down a lot of points, and I'm going to be dealing with them one after the other to explain to you guys in a 5-minute or so video, okay, to let you guys know what you should expect going forward. As you guys can see already in the comment section that I am very positive from this meeting. I think I like what I have heard so far, and I think investors also are showing some kind of positive reaction to this conference meeting. As you guys can see right now, Bngo is trading up about 3.5%. Not only Bionano Genomics, we have a lot of stocks right now, more or less turning green. Okay, Bngo, I made this channel when I started to, on this live stream, when I started, I, more or less drew this channel, and as you guys can see, the price is a little bit, above this channel right now, more or less signaling some kind of breakout. Okay, now let's quickly take a look at the stock market map so that, I can end this video. Hopefully I will have enough time to record a separate video today to let you guys know, what more or less a summary of this Fed meeting, and what you guys should expect, okay, going forward. As you guys can see, this is the one-day performance of the stock market, and it is green right now. Okay, the energy sector is more or less suffering right now. Okay, and that is what we hope to see. Occidental is down about minus 3.7% right now. I made a video last week when Jim Cramer told he made a video and asked everybody to start to buy the dip in oil stocks. Okay, and right now you guys can see that since he made that video, I think this sector has been suffering more or less. So what we want to see is money flowing a little bit, consolidating in this sector and flowing back into growth sector, healthcare sector, and so on and so forth. So that is more or less what we are expecting, and that is it. The market is green, guys. The market is green. Illumina, let's see what Illumina is doing today. Illumina is up 1.9%. I think something is going on fundamentally. Something is wrong with Illumina. Pac Bio is up about 3.9%. It's more or less a consolidation. I would expect Pac Bio to be at least closer to 4.5 US dollars, or 5 US dollars, but right now it's just up about 3.9%. and we have a lot of stocks out there that are more or less performing very well. Tesla, for example, is up about 4.1% right now. Amazon is up 4.1%, and so on and so forth. So thanks, Shashiku, shout out to you guys. Okay, shout out, and stock guy Yogis, a big shout out to you guys. See you guys in the next video, and of course I'm still going to make a post to the channel members to let you guys know more or less what I am thinking right now. Hopefully that is going to help you guys to make or save some money. See you guys in the next one. I remain your boy Dayo.